I then go through and look at all my costs, and I do the exact same thing. This is a real simplified one, and so all these costs are just given as a per acre. We're going to look at a little bit more elaborate ones here in just a minute, so we'll take those one step further. So these variable costs, we take each different component of things that we know we're going to have for costs. In terms of finding that information, usually we go back to what our costs were last year and the year before. So we know what we need to produce our product, and we look back at here's what we've been spending. Those may take adjustments too. Maybe last year we only spent $500 for seed, and this year we know that our seed costs have changed. So we want to make sure those are accurate for this year's setup. In other words, the things we're doing this year, the way the economy's going this year, how are those costs going to line up? So you'll see seed, fertilizer, pesticides, mulch, machinery costs. So we don't want to forget our machinery fuel, our lube, and repairs costs. That's usually, depending upon the different types of products, sometimes that's a really high cost, sometimes it's a lot lower cost. Harvesting is going to be one that's probably your biggest chunk. So oftentimes we will separate out our general machinery costs, and then our harvesting costs will typically be their own cost because it's such an expensive portion of what we do. And therefore, whether or not you're doing it yourself or you're having it custom harvested for you, you can still separate out that cost. Irrigation costs, if you have irrigation costs included, then you'll want those. And then this one actually lists some other variable costs. The labor may or may not be paid. So it might be cash labor because you hired people, or this may be your own labor in terms of value of what you think you have spent in hours per acre on your operation. Okay, so here's our labor costs. And then the last thing in our section on variable costs is our interest. So what we do is we say, okay, we're going to have all these costs during the year to raise our product for watermelon. But we also know that probably, as we've talked about in the past when we talked about loans and balance sheets, is that we probably have an operating loan to help us with that. If we don't have an operating loan and it's our own money, then this interest right here might actually be an opportunity cost for the value of your money that you're using. You could be taking that money and putting it into another investment. So if you're not borrowing the money, it still should have an opportunity cost of interest to it because that money needs to be valued that you're using to raise this product. So here's how we figure opportunity or interest on our variable costs. Okay, this is something that's calculated. There is a formula for it, and so it's one of those things you don't have to rationalize it in your mind. You just have to learn it. You just have to memorize the formula. So our interest on operating costs are basically going to be calculated using simple interest. And if you'll remember, simple interest is very easy. That's where we just take the amount or the principal times the rate times the time. So we just multiply amount times rate times time, just like we did when we figured accrued interest on our balance sheets. So our principal, or the amount that we're going to calculate interest on, is we're going to add up all of our variable costs. Okay? So we're going to take our total variable costs prior to calculating the interest. We're going to multiply by the interest rate, whatever the interest rate is that we're using, that is either for borrowed money or what we could make in another investment. And then this amount of time is always the same. We don't change that. We don't count up months. We don't do anything. This is a known formula. Just learn it, okay? So we're going to take principal times rate, and the amount of time is always going to figure it at a half. So basically, here's what we're doing. We're thinking to ourselves that on this enterprise budget, I've got all these variable costs for watermelon, and I probably have to have them borrowed. I have that amount of money borrowed across an entire year. I probably have it borrowed for maybe half of the year, okay? So it's not like I borrow enough to buy seed in January, and then I pay interest on that all the way through the whole year. Our estimation for enterprise budgets is that we use the time frame of a half when we compute our interest on our operating costs. So in this case, for the watermelon budget, if I had totaled up all of these variable costs to this point to labor, so I'm going to take seed down through labor and take every variable cost, those would have added up to $5,400, okay? The interest rate, okay, is given right here in my listing of how I describe it. I'm saying interest at 5%. So I'm going to figure my rate at 5%, And then I'm assuming again that half of the year I've got borrowed money in some way, shape, or form on these costs. So my time is 6 months out of 12, which makes my time a half. So I'm going to take my total variable cost times 0.05 times a half, and I'm going to find out when I multiply that my interest on variable costs is $135. So I'm going to put that in as one of my variable costs and add it to what I previously had added up, which was the $5,400. So now I have total variable costs of $5,535. Okay. It is super important then that we find profit at this point. So where it says income above variable costs, this is the profit we're making to cover the variable costs. So after we've computed revenue, we've computed all of our variable costs, including interest. We now want to see whether or not we can cover all the variable costs. Well, yes, we can. $6,400 minus $5,535 gives me income above variable cost of $865. So at this step of the game, I know that from an economic standpoint, I want to continue producing watermelons. I can cover the variable costs of production, so that tells me, yes, produce the product. Now I need to see if I can also cover all my fixed costs to see if we're making bottom line profit or not. So now let's go to fixed costs. Fixed costs, again, are those ones I just described to you. Depreciation, interest, taxes, insurance, land value, or rent. So we have machinery, depreciation, interest, taxes, and insurance, and we've got that listed here. We've got our land charge, and you'll see land charge done many different ways. Sometimes it's the value of the land plus the property taxes on the land, and it's all combined into one component. We just give it a figure per acre. Sometimes things are separated out. So this one shows all of the machinery costs for those dirty 5 things, at least the 4 of them here. Then it's got the land value, okay, for your land charge here. And then it's got some general overhead costs. Now, watermelon costs a little bit more to raise. So you kind of see that the costs for watermelon are pretty expensive. And so are some of these values and fixed costs. But we also saw that they make a lot of money too. Okay, now given that we don't get hailed out or different things like that. So we see that our total fixed costs are down here at $625. So my total costs are going to be taking total variable costs right here of $5,535 plus total fixed costs right here of $625. So total costs are total variable plus total fixed, and that's $6,160. Now it's time to find, did I actually cover all costs and make profit? So I compare my total revenue from here minus those costs I just totaled up to be total costs. So $6,400 minus $6,160 gives me an estimated profit of $240. So in other words, that's going to be, sometimes it's called the return to management, sometimes that's the words we use, but basically this bottom line is profit. Are you covering all costs or not? Which allows you as the manager to make some profit on the enterprise. You've covered your costs for labor, you've covered your costs for interest on everything, you've covered all your fixed costs, even if you own those things and aren't paying cash for them, you still made sure you could cover them. So what's left is profit for you for your management of your operation.